A very good evening to you from wherever you're watching. It's just a few minutes past 5 p.m. right here on Metropole TV. That means markets today. My name is Nina Shaban. Let's get down to business by starting off by looking at the stories that are making headlines in the world of stocks. Now, the Competition Authority of Kenya has approved the proposed merger between Kenya's Commercial Bank of Africa and NIC Group. The regulator said in a statement, according to Reuters, the competition watchdog body has said the approval was on the condition that no employees would be made redundant in the merged unit within 12 months of the deal's completion. The two banks announced the deal in January, in which current NIC Group shareholders would own 47% of the merged entity and CBA shareholders 53%. In March, Commercial Bank of Africa said its shareholders had accepted a share swap with NIC Group, and the merger was agreed by NIC Group's shareholders on the 17th of April, paving the way for the two companies to create the third biggest bank by assets in East Africa. Should the deal go through, it will make the first major merger in the sector since the government imposed a cap on commercial interest rates in 2018. All right, now, Kenya Reinsurance Corporation has announced plans to create a subsidiary in Uganda. In a notice to its shareholders, the company has said the expansion move will be subject to relevant regulatory approvals and board authorizations. The reinsurance has also announced its intention to increase its share capital through the creation of an additional 2.4 billion shares, as well as issuance of 2 billion bonus shares. This will see each shareholder receive 3 new ordinary shares. Now, just to take a look at the exchange rates, the Kenya shilling was stable on Monday due to lower demand for dollars by oil importers. According to Reuters, commercial banks quoted the shilling at 101 shillings buying and 100 shillings and 20 cents selling per dollar, unchanged from Friday's close. Let's take a look at the day's indicative exchange rates for selected currencies. All right, now, meanwhile, news just in on the international front. China has said it will impose tariffs on $60 billion worth of U.S. goods from the 1st of June in apparent retaliation after Washington announced plans to tax almost all Chinese imports, and Beijing will hit a number of American imports with tariffs ranging from 5% to 25%, according to a statement by the Tariff Policy Commission of the State Council, China's cabinet. Now, the announcement came after the latest round of trade negotiations to resolve disputes between the world's top 2 economies ended on Friday without a deal. U.S. President Donald Trump has increased tariffs on $200 billion worth of Chinese goods to 25% and ordered the start of a process to impose new duties on other $300 billion worth of items. The response was announced after Trump on Monday warned Beijing not to retaliate. China should not retaliate, will only get worse, the U.S. president wrote in a series of tweets on trade. But Beijing also appeared to dig in. Foreign Ministry spokesman Geng Shuang said at a regular briefing on Monday that, when I quote, China will never surrender to external pressure, end of quote. Global markets remain on a red alert of a trade war between the two superpowers that most observers have warned could shatter global economic growth and hurt demand for commodities like oil. Elsewhere in the Middle East, Saudi Arabia said on Monday two of its oil tankers were damaged in sabotage attacks in the Gulf as tension soared in the region already shaken by a standoff between the United States and Iran. It came as U.S. Secretary of State Mike Pompeo scrapped a planned visit to Moscow to head to Brussels instead for talks with European officials on Iran. Tehran called for an investigation into the alarming attacks and warned the adventurism by foreign players to disrupt maritime security. Saudi Arabia, the Islamic Republic's regional arch-rival, condemned the acts of sabotage with targeted commercial and civilian vessels near the territorial waters of the United Arab Emirates. A foreign ministry source said. Now, the UAE said on Sunday that 4 commercial vessels of various nationalities had been targeted by acts of sabotage of the Emirate of Fujairah. Saudi Energy Minister Khalid Al-Fali said the 2 tankers suffered significant damage, but there were no casualties or no oil spill. Fujairah port is the only terminal in the UAE located on the Arabian Sea coast, bypassing the Strait of Hormuz, through which most Gulf oil exports pass. Iran has repeatedly threatened to close the strait in case of a military confrontation with the United States. One of the 2 tankers that was attacked was on its way to be loaded with crude oil from a Saudi oil terminal for customers in the United States, Fali said. The UAE did not accuse anyone of responsibility but warned that carrying out acts of sabotage on commercial and civilian vessels and threatening the safety of lives of those on board is a serious development. No one was hurt, and Abu Dhabi called on world powers to help keep maritime traffic safe. Meanwhile, Asian markets were largely down on Monday morning trade as lack of a U.S.-China trade deal casts a cloud over the market. Investors watched the latest developments warily in the trade war between the world's top 2 economies after negotiations in Washington ended on Friday without agreement and a tariff hike on Chinese imports were into effect. Now, the economic advisor to the White House, Larry Kudlow, says U.S. President Donald Trump and China's Xi Jinping could meet next month on the sidelines of the G20 summit to hash out their differences on trade, but no new talks are yet scheduled. Trump has accused Beijing of reneging on its commitments in trade talks and ordered new punitive duties, which took effect on Friday on $200 billion worth of Chinese imports, raising them to 25% from 10%. Now, according to the U.S. Representative Robert Lighthizer, a tariff hike on almost all remaining imports from China that are worth about $300 billion has been hiked. China's top trade negotiator, Vice Premier Liu He, had earlier warned that Beijing must respond to any U.S. tariffs amid nervousness in China markets. State funds reportedly intervened to prop up shares on Monday and again on Friday when the Shanghai Composite closed up more than 3%. Tokyo was down 0.5%. Shanghai lost 1%. Singapore shed 1.2%, and Seoul slipped more than 1% in morning trade. S&P 500 index future dropped as much as 1.2%, and 10-year U.S. yields are hovering near the lowest level since early April, and traders will also be watching this week for earnings reports from China tech giants Tencent and Alibaba, and key data on China industrial production and retail sales slated for Wednesday. The same day figures are due for U.S. retail sales and industrial production. All right, and with that, we'll take a very quick break and we shall be back with more on the stock market right here in Kenya. All right, now welcome back. You're still watching Markets Today right here on Metropole TV with yours truly, Nina Shaban. And now in studio is Odhiambo Ramogi, who's an economist, just to delve into the different matters that we are going to be discussing this evening. Of course, our main topic of discussion is going to be the US-China trade war and what exactly does it mean to China. But before we get there, I'd like us to take a look at the closing numbers as at today's NSE closing bell. And I'll start off. My apologies. Good evening.
Good evening.
Sorry, I might be rushing through so fast, so be sure to stop me when you feel like I'm going too quickly.
No
now, we'll start off by taking a look at the gainers at today's closing. And the top gainer is Kenya Reinsurance Corporation Limited. That saw a gain of 14.16 points, followed by the Standard Group Limited that saw a gain of 7.16 points. Uchumi Supermarket followed next, a gain of 6.9, followed by Barclays New Gold, a gain of 6.48, and the last gainer that we're going to be taking a look at is Everready East Africa Limited, a gain of 5.26. Now, moving on to the losers. The topmost loser was I&M Holdings Limited. That saw a drop of 40.63. We have the WPP Scan Group Limited, saw a drop of 11.14. Unga Group Limited saw a drop of 7.35. And National Bank of Kenya Limited saw a drop of 7.01. And finally, Kenya Airways Limited, a company that we'll be discussing as well in just a bit, saw a drop of 6.13. Now, Odhiambo, very quickly, maybe we can start off by asking, on looking at the day's closing numbers, what exactly would you say attributed to the losers and the gainers' closing numbers?
Well, thank you. Perhaps the major gainer today was Kenya Reinsurance.
Yeah.
Partly attributed to their ambition of going regional. And of course, they are a strong company. Their fundamentals are right. So then the investor has confidence that their expansion program will mean growth of the company, and of course that means more value to the investor. On the other hand, the biggest loser is probably Kenya Airways, leave alone A&M, which I think is merely a correction. But Kenya Airways is informed by continued loss making. There's very little confidence in management to be able to move the company where it is now to where it should be. The interim plan of merging Kenya Airways and Kenya Airports Authority have fallen because there was a feeling that Kenya Airways will only shift its losses to Kenya Airports Authority, which as a parastatal has performed really well over the years.
Really well, yes.
Yeah, so there is no clear out or no clear plan or strategy of how Kenya Airways can lift itself out of where the digit has found itself.
All right. We'll be delving more into Kenya Airways in just a bit. I'd also like us to take a look at what's going on in the movers sector. Mumias Sugar Company Limited was able to trade shares worth 240,100. Kenya Reinsurance Corporation, which was one of the gainers, was able to trade shares worth 500,331,600. Kenya Commercial Bank Limited, which is KCB, traded shares worth 800,100. Equity Group Holdings Limited traded shares worth 2,231,500. And of course, our biggest trader is Safaricom Limited, with trading shares worth 8,460,600. Your sentiments?
Well, obviously, you will always expect Equity Bank, KCB, and Safaricom in the movers segment. I mean, Safaricom has delivered 24% in price gains between January the 1st to date. So it still adds value to go for as a stock.
All right. Seeing today's closing, seeing today the trading of the shares and the closing of today's bell, what would you say an investor should be looking forward to as compared to last week?
Well, there are quite a number of companies, first if we just go the calendar way, that are closing their books awaiting dividends, the likes of Bamburi. So would expect some move in that direction. Of course, there are a few that might be correcting after a high of last week, like what you've seen with Equity Bank, which is also informed by high amount, as they reported, of bad debts. But on the other hand, I think I'm still hopeful to see how far the bull run in Express Kenya and Longhorn Kenya would go, because we've seen significant improvement in the two shares, or in the two counters, since the year began.
All right.
Yeah.
Okay, moving on swiftly, I want us to take a look at the different topics that we have to look at today. One of them being the 40 billion worth of pension savings that was slashed at the NSE, which is the Nairobi Security Exchange. Now, just to bring you up to speed with what exactly we're going to be discussing, this was a stock market bear run eroding almost 40 billion of workers' retirement savings, and this pulled the pension industry assets into a fast decline in 7 years. Now, the question to open this subtopic of Odhiambo is, could you kindly explain to us what is suffering paper loss? What does that mean? All
right, so if you go to the stock market today, and for instance, you buy, let's say you buy Kenya Airways at 3 shillings. And then in the next 2 weeks, Kenya Airways loses further to 1 shilling. So in essence, you have lost 66% of your investment. But it is a paper loss because you have not traded those shares. You still have the shares, the number of shares you bought are still under your name. In other words, if the fortunes of Kenya Airways should turn around and Kenya Airways perform much better and exceeds the 3 shillings you bought it at, perhaps get to, let's say, 6 shillings, your losses will be, so to speak, cancelled out, and you will instead get 100% gains on what you had invested. It is still a paper gain, of course, until you sell your shares. All right.
Now, just slightly away from that, kindly break down for us the correlation between the workers' retirement savings and the Nairobi Security Exchange market slide. How are they interrelated?
Yeah. So a few years back, the Retirement Benefits Authority instructed those companies and NSSF on what they should invest in. One of the things that they were allowed to invest in is the stock market, the bonds, real estate. They were, of course, instructed not to invest in some instruments of investment. So now a good number of them are invested in the stock market. And this is across board, whether it's Sanlam or Britam or NSSF itself. But unfortunately, our stock market has not been performing very well over the past few months. So if you come to like this year, there are about 15 companies that gave profit warnings. That means that at least 15 companies in the stock market reported 25% less income than what they had reported last year. So that is a loss for any investor in the stock market. Now, because a large chunk of pensioners' money is in the stock market, that means, therefore, that they carried a majority of the loss at the stock market.
A whole 40 billion.
A whole 40 billion, whether it is through NSSF or these other institutional investors like Sanlam. Yeah.
All right. Now, what you've just said is exactly what RBA attributes the loss to. They attribute the losses to the decline in the stock markets. So, what exactly does this say about what's going on at the NSE?
The NSE, of course, any stock market will be affected by several factors. One of these factors is the local economy. How is the local economy performing? And the local economy has been underperforming in the last few months, or should I say in the last 1 to 2 years, attributed to higher level of debts, attributed to over imports, and I mean the balance of trade is unfavorable. Poor governance, if you could put it that way, attributable to high levels of corruption. And so all these affect the economy of the country. But there are also other international factors that affect the performance of the stock market. And these could be issues of currency. How is our currency compared to the international market of the currencies? And so far, not so good, I'm afraid, because the international climate has not been very favorable for the local market. The local economy itself has not been very favorable. Even regionally, if you look at the other stock markets that traditionally perform very well, like Tanzania and Uganda, they are underperforming because of the international factors that are attributed to perhaps recession and the trade wars that you are yet to talk about. We are yet to talk about. Yeah. So I wouldn't say that it is one or two people to blame at the stock market. I think it's an international problem.
All right. So is this situation ever going to change? Will it continue, or will it continue being sluggish?
It's a bit sad to say that there is no clear way out of where we are until and unless something gives in terms of economic performance, because you realize that even apart from the profit warnings, there are numerous companies that are getting out of the country, or closing industries or closing businesses. So
two companies have already been delisted. There was the Atlas company that was delisted just a few years ago.
Yes, and beyond that also, you see, we reported 6% growth the other day. And what we were asking as economists is, where is this growth? Because
where is it being felt?
Yes, no one is feeling the growth. The middle class is not feeling the growth, and the bottom of the pyramid is not feeling the growth. And so then you are wondering, where is this growth? Which leaves a whole discussion around the statistics that we have as a country. But mainly speaking, there is no growth in this country that you can actually report and say that this growth is going to take the stock market to the next level.
All right, let's put that aside for just a bit. Now, the Competition Authority of Kenya has given CBA NIC a go-ahead when it comes to their merger. And one of the regulations that they put out is that both the companies have to retain their employees for at least 12 months. Now, is this a fair deal or not? We were having this conversation before and you said, well, it's not really a fair deal. So what are your sentiments when it comes to that?
Well, as an investor, I say kudos. I think it's a great way forward. After the banking law that was implemented a few years back, it was expected that banks will merge. After this, I think KCB is buying Imperial Bank.
Yes.
And so you expect some of these mergers to take place. After all, you've had it said over and over again that Kenya is overbanked. But now, moving into the interests of the employees, the regulation given is very lenient to the employer, because the employer can just decide, all right, we will retain them for a year, and then by June next year, we can actually let go of them. And there will be no recourse.
So 12 months is actually a short time.
It's a very short time to say that you cannot lay out in 12 months, but immediately after 12 months, you are at liberty to do so. I would be looking at something maybe 24 months would be more practical, because then management will be forced to think, how do we enhance our business strategy to ensure that the resource we have can be useful to us in the mid to long term. But as it is right now, they can just say, you know what, let's sacrifice 1 year and then get rid of them. Yeah.
And then now what next after the merger, knowing that NIC is a listed company and CBA is not?
Well, after the merger, they will still remain listed as NIC, but CBA would have around 53% and NIC shareholders will have 47%. I think it's still a good deal, considering the fact that CBA has a larger platform on M-Shwari. It has a larger number of clients, I think going to over 40 million, so to speak. So this presents a great opportunity for NIC to expand its reach. It also presents an opportunity for CBA to go beyond its traditional market, which is the middle class, to the small business, small and medium enterprises, which is a forte for NIC. So it's a very, it's a win-win for both companies. Moving forward, I expect that they will have to now adjust their business practices to reach both markets, to leverage on their strengths, and to deliver some sterling profits.
Okay, so but very quickly, how long will their merger take, or rather, how long is the process for their merger to become a success?
You do know that it has already taken around 6 months, because they announced it in December last year. We have come to May now, they have the approval. So as of now, it's a matter of management saying we will announce this on this date and sign on the dotted line, because they have the regulatory approval. I think they already have shareholder approval. What they need now is just for management to sign on the dotted line, which perhaps in the next 1 month we should see come to fruition. Now the bigger duty would be rebranding, which is more of a marketing one.
All right, and we'll be waiting to see what happens as that story continues to develop on their margin. Now, to our main topic this evening is we would like to unpack the US-China trade war. Now, just to bring you up to speed, the latest news on the US-China trade war is that China has said it will impose tariffs on 60 billion US goods as of the 1st of June 2019, and this move comes after the US move that doubled tariffs on the 200 billion Chinese imports. Just to be clear, tariffs on the 200 billion Chinese imports moved up by 25%, and now while those of the 60 billion US imports will move up by about 10 to 25% as well. They're just retaliating. What China is doing is retaliating. Now, Odhiambo, it's evident how this trade war is affecting even as I read news, I'm sure you heard, it's affecting even the Asian markets. Let's unpack the trade war. What caused it? Where did it start from?
It starts from the trade deficit between China and the US. China exports goods worth over 519 billion US dollars to the US. The US only exports goods worth 112 billion US dollars to China. There is actually it's I think 120 or something, but there's a trade deficit of around 419 billion US dollars in favor of China. So the US is feeling, you guys, you are eating all the pie and leaving us with the crumbs. If this was a small nation, a developing country that is just starting up, the US would not have minded, as long as they are allies, they would not have minded. But this is China, which is competing to be the next world superpower. And so your greatest competitor is taking advantage
He's making so much money from you.
And you're not making money from them. So this is what Donald Trump said, it's unfair, and then decided to start the trade wars. And so where we are right now is they have been having these conversations, but China is dragging its feet. Now, economically speaking, the trade was in favor of the US, because traditionally when you have uncertainty around the globe, the markets slump, and investors for traditional reasons head to the US, and they invest in the US because they feel that's the strongest economy there is. So when there are jitters across the globe, they head to the US. So that's why the Dow Jones lost only 6% last year, while the Chinese Shanghai exchange lost about 11%, and I think another 19%. So now, economically, the US is at a good position.
Yes.
But politically, the US is not in a good position for two reasons. One, they are going into an election, and Donald Trump needs a win before this election. And so he wants to sign this trade deal before then, and that's why he's pushing with everything he has. And China knows this. That's why they're dragging their feet. They know they do not have the muscle to retaliate, because if you look at retaliating on 60 billion, and this person has given you 200 billion
yes.
Tariff, and is threatening to do another 300 billion, you know, the impact on you is greater. But right now, what China is doing is just dragging its feet, because they know Donald Trump needs a win.
Okay.
But the second thing, before you go to the next one, is Donald Trump has managed to alienate the US from the rest of the world.
Yes.
Because they have put tariffs on goods coming from the Eurozone, and the Eurozone has retaliated. They have put tariffs on goods coming from Turkey, and Turkey has retaliated. They have put tariffs on goods coming from India and Mexico and Canada. So they are now all alone in this battle.
All right. Now, it has become a tit for tat, as you're saying, especially with the US and Donald Trump's different ambitions and whatever he wants with winning the elections. Now, the tit for tat is very evident. And those in the businessmen out there, especially the ones who are incurring losses, are very hopeful that during the G20 summit, Donald Trump and Xi Jinping will sit down and maybe have a conversation and end this trade war. What do you see from the G20 summit? Is this actually going to happen?
The truth, and perhaps this is why Xi Jinping is very confident, is that a number of the companies that are importing into the US or exporting from China into the US are actually American companies. That left the American business ecosystem,
the environment,
and went into China and started doing business in China, and now are importing back into their country. And so Xi Jinping is not worried, because he really doesn't need the American market as much as he needs Africa, as much as he needs Asia, as much as he needs Mexico. Because at the end of the day, he doesn't need to do all the heavy lifting. The American companies will have to lobby their government, will have to lobby their president on their own, and all he will do is come and sign on the dotted line. And so even during the G20 summit, the pressure is more on Donald Trump as much as it is on Xi Jinping. In fact, Xi is not in a hurry. He would love to drag this.
Just fine.
Yes, he's just fine. He'd love to drag this as much as he can, because he's not on the losing end in the short run. In the long run, of course, he has a lot to lose. And so then, for them to agree to meet at G20, it means that they both have recognized that they need each other.
Can China replace America? Because America, they have a very, the business relationship is huge. So can China replace America? Can they get another country or another area that will give them this $500+ billion worth of business?
Well, can China replace America as a trading partner?
Yes.
As a trading partner, they need America, of course, because 519 billion is huge.
It is.
But what is not clear is, can they survive without the US? And the answer to this is they have their own markets. They are shifting their economy from more production to more consumption. They have the African market that they are intentionally developing to consume their products. They have the Asian markets. So they may not be able to replace the US, but man, they can survive without the US.
They cannot survive without the US.
They can survive.
Now, speaking of the
US.
Asian market, how exactly is this trade war affecting the Asian market?
Significantly so. You do realize that where we are, and I think I saw, just before I answer that question directly, I saw a comment somewhere. JP Morgan is saying that where we are right now in terms of trade wars is going to be the norm. Because, so to speak, the global market has come of age. Everyone has a negotiating power at the table. A few years back, the Asian tigers would not sit at the same table with Canada and the US and Australia. Today, they are sitting at the same table, including Brazil and South Africa, or the BRIC countries. But now, coming into where China is with this, with the Asian market, they are like the largest partner there. And so it's like they are the same position Kenya is in East Africa.
In East Africa, all right.
Because they are the largest economy, they have a big say, they are a large market, and so they have a way of pushing their agenda into the rest of the Asian countries.
All right. Yeah. Now, most observers have said that, rather they've warned that this trade war could shatter the global economic growth. How true is this and how?
It is possible. In fact, you've already started seeing it, because the trade war between US and China is perhaps the one that is most talked about on news.
Yeah.
But then the alienation program by Donald Trump started long ago with the Eurozone, as I listed before. And so what this means, therefore, is when you have barriers, trade barriers being erected all over, then the volumes of trade goes down. And when the volume of trade goes down, economic growth, of course, is affected significantly. And currencies are affected, and we might see ourselves in another recession.
All right. So how does it trickle down in detail? How does it trickle down to Kenya?
Well, this means that if the economy of the US is not doing well, we cannot export. We are beneficiaries of AGOA, African Growth Opportunity Act. So if the trade wars continue, it means then that the US economy is slimming down, and when it is doing so, it means we can't export to the US. It means China holds off on several programs it has in Africa, investment programs or loan programs that it has in Africa, and that affects us significantly because China is our biggest creditor so far.
At 70%.
Yes. It means, therefore, that if this trade war continue, Europe is affected, and Europe is a big buyer of Kenyan horticultural products and agricultural products. It means, therefore, that our exports reduce and our economy is affected significantly. In other words, when America sneezes, the rest of us will catch a cold.
Wow. Thank you so much.
Thank you.
Thank you so much. That was Odhiambo Ramogi, who's an economist, just to bring us up to speed on the matters that are affecting business, not only in Kenya, but the world at large. My name is Nina Shaban. That's it for Markets Today this evening. Don't go anywhere. I shall be coming back at 7 p.m. with our 7 p.m. Metropole TV news. Enjoy the rest of this, maybe 1 hour from now to 7.